Yeah, Simon, I'm so excited to talk about all of the different subsectors of fintech and how this new volatility regime is going to impact them. But also at the end, and this is the thing I'm even more excited to talk about, is how founders should be thinking about responding to this new environment we're in, whether you're at the idea stage, the pre-seed and seed stage, Series A, B, C, D, or thinking about an IPO. I think there are some important lessons for what you should be spending your time and energy on at the moment.
Good to see you, my friend. Coming to you live from a very messy house, but also a very messy and very volatile market.
Yeah, and that's what I want to do here is there have been some crazy swings in the market. These are the biggest swings since the COVID shutdown. And so let's unpack what that volatility means for fintech. In particular, you put together a fintech vulnerability index. And so I thought it'd be good to drive through the different subsectors within fintech and talk about how they're exposed to these shocks, understanding that in times of volatility, you don't even know what all the shocks are going to be, but we can at least walk through kind of where we are today.
Yeah. Well, I think let's start off the top with one thing that's not in the index, which we were chatting about before the show, which is like the amount of IPOs that have paused. You think you had a great stat about the amount of market cap that is not going public.
Yeah, it's about $50 billion just of fintech market cap and about $100 billion or so overall. So if you're looking just at fintech, Chime, Klarna, Circle, eToro have all paused or chosen not to file and when they were planning to file. And that's to say nothing of folks who are thinking about maybe getting to the line and chose not to. And so that is the most salient, I think, impact is all of this liquidity that was about to come back into the venture ecosystem and also all the visibility that was about to happen about how are these companies actually going to be received by the market. That's on pause indefinitely.
And it's on pause, and we don't know when you're going to unpause it because the volatility's there. The unpredictability of markets is what's kind of bothering everybody right now. Like, if tariffs are paused for another 85 days or so, are they going to be unpaused again? Are we going to get something else? And so if I've paused my IPO, like, how long am I waiting for here? What's going to make me feel safe to kind of unlock that? Can I try and rush it before that 90-day period runs out? It's kind of crazy. So yeah, should we run through this one by one?
Yeah, I think we should run through the different areas of the fintech vulnerability index. And yeah, to your point, we're going to keep going through this for a while. I think the chance of recession, if you look at the prediction market, spiked from like around mid 30% to up to 60%. It's back down now. Who knows where it's going to go in the future? Don't want to prognosticate too much on macro, but I think what we can talk about is some of the sensitivities of all the individual areas in fintech. So why don't you kick us off and maybe just take it from the top with lending platforms and what you're seeing going on there?
Yeah, so the hypothesis here is we had some tail risk of recession kind of anyway before the tariffs, right? Like going all the way back to DeepSeek being launched and some of the froth coming off some of the AI hype. There was some worries about 2025 and if you assume that there was some tail risk anyway, and this has just accelerated that tail risk of a recession, then typically what you see is if we're worried about consumers, if we're worried about businesses, then lending, especially specialist lenders, are usually some of the more vulnerable. So you would think about Affirm, you would think about SoFi, you would think about those specialist lenders who may not be banks because they have a double exposure. Their customers are becoming less potentially likely to repay them, so they have some deterioration in the repayments. The credit deteriorates, as we say, on one side. And then on the other side, actually getting credit themselves to be able to lend with kind of goes away. So I've got less people repaying me, and I've potentially got a harder time getting the capital in the first place. Now, I think some of that's going to be mitigated by the nature of just the size and scale of some of the private credit deals that Affirm and Klarna have been able to sign. They're in kind of a different category. But you come out of this sort of top 2 or 3 lender space and that middle bracket of like non-bank lenders, that could get very interesting indeed.
And there's another subsector, which honestly is bigger than the rest of all the subsectors put together combined, which is mortgage. And mortgage rates have been there higher for longer. The Treasury has actually gone. We're in this weird place where maybe having inflation and also having high interest rates and also having a deterioration in consumer confidence. And the mortgage market, we've been way below kind of averages in terms of home sales. And that's going to continue to be the case because higher rates make it harder for people to afford new homes, especially when they're locked into, a 3 or 4% mortgage that's super affordable. And so a lot of the economic cycle is often the housing cycle. And this isn't good for consumers who want to borrow or, taking cash out of the home has other issues, but it is one way that consumers can have more access to purchasing power, and that's not something they're going to be doing.
It's a sign of the times that I've actually seen several companies in the past few months that do assumable mortgages, which is where you can assume the rate that the person you're buying the house from had with their bank. So maybe you're buying from a retiree who's going into a retirement home or something along those lines, and they had a sweet 2% rate. You could assume that rate, and there's quite a lot. I think there's something like 25, 30 million properties that have that capacity, but that's a drop in the ocean, and so that is not going to lead to new home building. It's not going to lead to all the economic activity that kind of comes kind of around that. Is there anything else on the lending side that you can see that makes other subsectors vulnerable?
I think the other question is just how is consumer confidence going to evolve, and also what's going to happen with employment, especially for the middle class, which is where a lot of the lending tends to take place, and that we're too early to see. But the markets will understand there's a lot of potential volatility and exactly where consumers are headed, and so that's not going to be good for share prices of these kinds of companies.
Indeed. Well, next up on the vulnerability index, we had payment processors, and typically their total processed volume is like their core metric. So Stripe and Adyen and others had a banner year this year. E-commerce was up. I think Stripe's TPV and Adyen's grew something like nearly 40% to around the 1.4 trillion region. I mean, that's phenomenal. People are buying new AI products. They were shopping online. 2024 was a great year. And they were already predicting softness for 2025. But again, if that consumer confidence, if consumers are spending less, then they're also the payments processors who acquire all of those funds, the acquirer processors. They're seeing less volume, they're seeing less transactions, and so they would be impacted maybe in their growth and how that seems. And that's a big part of the payments industry now. That's meaningful, so we could expect to see potentially some softness there.
Yeah, and they're just tied directly into consumer spending, and if that gets impacted, it's not good for the payment processors. But the good news is, if you look at how they trade from a multiple basis, like the Visas and the MasterCard, not that I guess those are the networks versus the processors, but they're pretty stable, sticky businesses with high multiples. And so, it's not like we have to worry about them going anywhere.
And they've kind of done well throughout the cycles historically. They tend to see that consumer spending shifts away from discretionary towards staples, but they're still seeing the overall payments volume. So depending on how well indexed you are, then you can do well or bad. What's interesting to me is it may actually be some of the processors like a Chase or a WallPay and those guys who have some of the more legacy bricks and mortar businesses, some of the discount value stores or the everyday staples that start to do a little bit better versus the discretionary online spending. And indeed, a lot of the discretionary online spending was going to international e-com, to things that were being sold through Amazon Marketplace and so on. People are buying less crap and more stuff they need. That could benefit some payments processors and possibly damage some others in the process. Next one I'm very interested on your take on. So wealth management. So if markets are declining and my business model is based on assets under management and my clients have less assets under management because of the mark-to-market value, potentially my revenue goes down. But then not all brokerages, not all asset managers are created equal. There's some very different animals in the market. So how do you think about brokerages and wealth management?
Yeah, you're absolutely right. And let's break apart the market into like wealth management for very wealthy people, like RIAs, where they're charging, somewhere between 50 basis points to 1 percentage point per year to manage those assets. And you're right. In aggregate, if stock prices and asset prices are down, you're not going to see the same revenue growth. Usually, though, wealthy clientele tend to be the most insulated from shocks. And the wealth management businesses are pretty stable. And it's not like they might experience slower growth, but it's just for a period of time. So it's not good for their revenues, but it's not terrible. They're perfectly capable of weathering these storms. I think where there's a more interesting question are for brokerages that have a more volatile revenue stream, like say a Robinhood. So Robinhood earns a lot of their money from day trading, and the industry term is daily active revenue trades, or DARTs. And the last time we had a big period of economic volatility, we saw DARTs skyrocket, right? COVID lockdown happens, tons of volatility, everyone's at home, nothing to do. They start day trading stocks, and then a bunch of stocks started going up and to the right. And that's like a perfect recipe for a lot of people to start doing trading, which is not much else to do. Number goes up and to the right, and there's volatility, so it's like exciting. Right now, we have some of those ingredients. There's a lot of volatility, but the numbers aren't necessarily up and to the right. So what are day traders going to do? It's really exciting to day trade when you see your portfolio growing. It's less exciting to do it over time if it's not growing. And so what that means for like the Robinhoods and the other discount brokers of the world, that's going to be interesting. But you're also seeing people like Robinhood trying to lean into building larger, more diversified businesses. They have their cash account. They have their credit card with both interchange as well as revolvers. And as they talked about with Robinhood Banking, they want to get into the more stable kind of wealth management side of the business. And so I think core wealth management businesses, like, yeah, it's not great, but they're totally fine. But it's going to be more interesting to see what happens to retail sentiment as applies to, active trading in the markets.
Yeah, meme stocks and meme coins are probably a sign of peak consumer sentiment, and the opposite is also true. In 23, we saw that those volumes just cratered, and the Robinhoods and Coinbases of the world suffered, and they've become much more balanced and diverse businesses, as you rightly pointed out. So they're able to weather it, but that revenue line is potentially impacted. I think that's a great point. So next up on the index, I had banks. And this is kind of like a 50-50 because banks that are big enough to weather the storm will absolutely be fine. But I can imagine this impacting just about every business line, right? So whether it's trade and working capital, like trade finance, if there's less trade going on, then that's going to be challenging. If you're looking at things like the trading desk, then maybe there's more volatility. There's things going on there. But the core commercial franchises for the mom and pop stores, the core consumer franchises, again, might suffer from less transactions, lower balances. There's always demand for credit, but is there credit quality? Can you really lend to them? But banks have seen and build their business model about being robust throughout these cycles, and there are always pockets if you are balanced enough to be able to do that. If you're a smaller specialist bank that does certain types of SMB lending, then maybe that's a little bit more challenging, especially if that industry is really impacted by the volatility. But if you're a larger global bank, then maybe being able to extend more credit to help people through some of this volatility, maybe some of your risk management products could be super valuable. And I think we'll see a lot of creativity from some of the global banks actually really playing their role as shock absorbers for the economy in a way that they probably haven't had to do so in quite some time. So we could start to see their value. What are your thoughts on banks?
The big banks are big, diversified businesses, but at the core, what they mostly are credit machines. And so one of the big questions when you have economic volatility is, are some of the loans they made actually not going to end up being good loans? Mm-hmm. And you don't actually know that until 12 months later. But that's what really hits earnings, is when they have to do a big write-off for loan losses. Now, in advance of that, what banks will start doing is they'll start allocating for loan losses that hit their current P&L. And so you can actually see that a few of the big banks like JP Morgan have increased provisions for credit losses for their card lines because, we're worried about consumers, we're worried about interest rates, we're worried about confidence. So they've already started to take some of those hits, but then you don't really know how it's going to end up in 12 months. So that's one of those places where banks in the medium to long term do not like this sort of economic volatility. But, and you have this in your thing, actually in the short term, volatility is really good for certain lines of business. So you mentioned how banks they have kind of a shock absorber. They also have different lines of business that help balance out all of the activity across the sectors. So Wall Street Journal this morning is writing about how JP Morgan and Goldman had record profits on their trading desks. Because when you have a lot of market volatility, people are calling up banks and they're doing trades, and banks make money from that. That's great. That kind of gravy train doesn't run on forever, and eventually it gets eclipsed if you have really bad macro credit events. But at least in the meantime, it does give them some stability through volatile times. And so that'll be one of the big questions is, okay, they're fine now. The trading desks are dampening some of the credit impacts. But if we keep having a really volatile time, eventually banks go the same way as the rest of the economy.
Yeah, it's one business line. It's not all of the business lines, and it can do very well for a little while. But once volatility becomes the new normal, then the market adjusts to that new normal, and the risk management products they buy starts to really change. There's the VIX, which is the volatility index that people used to just it was the most boring product in the world. What would you buy that for? You would just sell it. You would just sell this thing unbelievably because there was never going to be any volatility. We were in the ZERP era. And now, actually, it's a risk management product that seems to make a little bit more sense and is really making a comeback. And that flip of the new normal will eventually start to net out. And yes, as you say, the short-term benefit may give way to long-term pain in the rest of the organization.
I'll also call out neobanks here because I think one thing that's interesting is neobanks are mostly monoline today in terms of the products they have. And so they can get more susceptibility to shocks than the big banks do. And this is one of the reasons why we've moved towards having these big universal banks as they move through shocks more easily. But if you look at Mercury recently, you did a round at a $3 billion valuation. They basically make all of their money from net interest income. Now they do have subscriptions for their personal banking product, but largely they're very rate sensitive. Now they're fine in this environment because rates have actually gone up a little bit, so they're not good. But that's one thing that's interesting for me as a fintech investor to think about is how do these neobanks who have started, largely as monoline expand into a product bundle that generally drives revenue up, but also gives them more stability through different kinds of economic cycles or interest rate cycles. And we're just starting to get to the point where people are rolling out new and different kinds of products. And so that's going to be an interesting, medium-term thing that I'm kind of tracking and thinking about. And we talked about this with Robinhood, right? They want to do not just day trading, but also retirement assets and also maybe even high-end wealth management.
Everybody's rebundling finance. I'm going to come back to the, especially some of the debit card-led neobanks, because I think they could end up doing really quite well. But I'm just going to talk about RegTech, fraud, compliance, and this is uneven because you always need these things. They're kind of a utility. Generally, there's a lot of fraud in the world, but now we've got all of this new compliance, potentially, stuff, and you need to be able to change it on a daily basis. There isn't necessarily the cross-border trade tariff compliance tool existing yet, but maybe that could become space, and maybe a lot of people that play there, especially in some of the AI tooling, I think that we could start to see folks that really just help you branch out. There's how many YC companies take that compliance rule and turn it into an AI. That space could potentially do quite well, and I think it's one of those sort of evergreen sectors that you always need. Compliance always exists. The law doesn't go away. But at the same time, there could also be some sparks of opportunity in there.
Yeah, I've really enjoyed following Ryan, the founder of Flexport, talking about a lot of the implications of global trade. Flexport is a platform through which global trade is facilitated, both from a functional coordination standpoint, but also from a regulatory compliance standpoint, and just has a lot of good insights around more volumes are shifting here. Sometimes there are surprising impacts, which is domestic manufacturing in certain categories is actually moving out of the U.S. because their inputs are subject to tariffs, and so they'd rather have manufacturing outside of the tariff world of the U.S. and then pay the tariffs if they have to ship it into the U.S. So there are all sorts. It's just a very complex world, to your point. And so I love listening to some of these voices who can kind of shine light on what that complexity looks like. But then, to your point, it also creates need for platforms like this to help facilitate and manage the new, more volatile world we're living in.
Penultimate, crypto / on-chain / stablecoins. The obvious thing is that, weirdly, yes, we saw a price dip, and there is a correlation between Bitcoin and the Nasdaq, and they were fairly close, but they actually broke correlation, and Bitcoin has been somewhat more stable. I'm saying this in a high-pitched way, but there's a non-zero probability that we are seeing the decoupling of like crypto as a risk asset. It's funny that when Bitcoin formed, a part of it was in the backdrop of the global financial crisis, of the view that there was no risk-free asset, that central banks were not as trustworthy. And for the first time, the idea of treasuries and the full faith and credit of the US government has been called into question by markets. And in that time, gold has done incredibly well, as have other currencies, and nobody knows what the new safe haven asset is. There was always a narrative that it might be Bitcoin. I still think we're a long, long way, let me be absolutely clear, from that being the case. But what's fascinating is, whilst it has suffered, it's certainly not suffered nearly as much as you might expect it to. And more broadly, one of the biggest buyers of treasuries are the stablecoin issuers like Tether and Circle. So they find themselves in an interesting spot where if anybody has leverage, and their leverage has actually increased, it's probably those, because there aren't a lot of net buyers of treasuries. There's a lot of net sellers. And that's hence the yield going up, and hence some of the issues that are around that. So we already had momentum behind the first killer app of digital assets, which was the US dollar for everybody else. But now potentially we have the second killer app, which is, what about stablecoins in every other currency? What about cross-border that isn't as treasury-centric? Or what about stablecoins as a way to shore up treasuries? It pulls on that thread, and it gets really, really fascinating. But we certainly have a digital asset crypto-forward administration, and perhaps this is one of the bright spots of the next few years in fintech with a classical sense.
Yeah, and I think this is an area where the tariff volatility doesn't apply so much as the regulatory framework, which actually seems to be less volatile and uncertain than it used to be. And I think you're right that will mean stablecoin use and adoption will become a thing. There was news, I think, just a few days ago that USDT is considering issuing a stablecoin that complies with U.S. regulations in the event they become, those regulations get made. And they've been completely anathema to that for a long time. And so that will be the one area where there's actually less volatility than there was under the prior administration. And so maybe we'll see some interesting stuff done there.
I have one more category, which was, I alluded to consumer debit, and I separated this one out. I didn't call it neobanks because there's lots of types of neobanks, but Chime and Cash App in particular actually could benefit if there are job losses, if consumers do now need to rely on more sharing economy, more shift work. I mean, these apps are purpose-built for that sort of income segment and people with multiple income streams and still being able to generate credit. Some of their product innovation could actually set them up to be kind of a broader swath of the population. Generally, we viewed this as quote-unquote subprime, but what happens if that market segment expands is people that have done well there historically potentially get a bigger TAM. So that's one area that I think could do really, really well. There's a great quote from a great tweet by the former CEO of Marqeta here, which is, did you know that Cash App is the 4th largest debit card issuer in the United States, and it's the fastest growing because it caters to the forgotten 50%. The forgotten 50%. I mean, this is truly phenomenal. And to your point about cross-selling, both Chime and Cash App seem to have gotten their mojo on adding new product features in the last 6 months. So do not bet against these guys. Like, actually, this market turns towards them in a way that I think could be net beneficial for them as a business, but also a bit of a safety net for some of the economy.
Yeah, I think exactly what you're saying, which is kind of two things. One, the rebundling idea. They're building more product, which allows them to expand up market, maybe at the same time as more consumers are facing more pressure and kind of moving down market in terms of the kind of products they need, which creates a bigger overlap with the platforms of the Chimes and the Cash Apps in terms of who they can be serving.
So I'm going to leave you some conjecture, some speculation, some opportunities that I think could exist. And you can react to them any way you think. Because I always think whenever the market changes, entrepreneurs like sniff it out and they'll do inventive things.
Yeah.
But sometimes I like to like just shine a couple of lights based on my experience on where might that be? Where should you go poking around? So I think the obvious one is supply chain financing for companies that are reshoring production. I can imagine a big bank doing that quite well for their big corporates. They've probably already done it. They've probably I'm sure the Nvidias of the world have plenty of banks chasing them. But what about everybody else? What about mid-sized factories where most of it was in Mexico or China and you wanted to reshore it? What does that product look like for Middle America? What does that look like for smaller businesses? And then the second thing is maybe your Toasts, your Squares of the world. Do they have a working capital solution for somebody that suddenly has 10% higher inventory costs? And what does that shock absorber product kind of look like? I think that could be an interesting one. And then the third one I had was a stablecoin payment solution for new trading corridors as supply chains are all moving. So it's hard to get dollars in and out of Vietnam, but stablecoins are a little bit easier. So actually the movement of value here could start to shift to stablecoins. And the great thing about programmable money is you can bake in a lot of those custom border protection changing rules by the day to the stablecoin itself. So I go and make a payment, and if today the tariff is 10%, tomorrow the tariff is 2%, and then it's 30%, I can just automate kind of a lot of that into the stablecoin. So I had a couple more, but I don't know. I'm curious as to what you think the entrepreneurial community will do here, and if you're seeing any early signs already.
Yeah, and I think that's a great thing to conclude on, which is if you're a founder and you're listening to this, what should be your takeaways for this kind of new regime that we're in? And the first thing I would say is, if you're thinking about, let's break it down by stage. Like if you're at pre-seed or seed versus Series A through Series D versus pre-IPO. So first, if you're like looking for an idea, I think a period of volatility can give you some interesting insights into like where there's immediate pain to maybe sell into, but you really want to identify a long-term durable trend. And so that immediate pain can also be misleading because it might go away in 3 to 9 months. And so really the most important thing to still be thinking about is AI. This week we also had ChatGPT or OpenAI drop some new models that are 90% cheaper, way higher context and memory. That is the big trend you should really be paying attention to and fundamentally rethinking what you could build and how you build it. But you have to have a first customer. And so periods of volatility can help you identify initial customer sets who have a lot of pain in the moment. So I think that's the most important thing is like AI is still the big story if you're an entrepreneur. This just maybe gives you a lens to think about who might be your early adopters. Then if you're seed to Series A, I think the shocking or somewhat surprising answer is that a lot of this volatility doesn't impact you. Your biggest thing to worry about is like, is someone going to fund my business if I need more capital? And VCs, they go out and raise money and it's locked up for 10 years. And a bunch of VCs have raised more money than ever before. So if you're solving a real pain point, there will be follow-on financing at the seed, the Series A, the Series B, the Series C, even like the Series D. I think A16Z was in the news because they're going out and working on raising a new $20 billion fund. And there have been several other folks who have raised $10 billion funds. So in the private markets, there is capital for good people building interesting companies, solving real problems. The area where it's most relevant for founders is if you're thinking about doing an IPO. Well, one, congrats, you built something pretty awesome. You're pretty far along. But that's where it's pretty clear things are on hold. And then if this volatility continues, that volatility tends to get pushed down into the private markets, but it lags the public markets by 6 or 12 months. It depends on the nature of the shock, the extent of the shock. But for now, for the most part, a lot of this volatility is still insulated from what's going on in venture world.
I think that's the best place to leave it. Founder insights that you can use from the one and only Rex Salisbury. We successfully talked fintech. I'm glad. We should probably do this again sometime.
We should do it again, and then hopefully the story, hopefully this won't be a recurring theme of how to deal with macroeconomic volatility.
Let's flip it. Let's turn it into the FinTech Opportunity Index and just make it an optimism story. It feels more American that way,
Let's do it. I appreciate you. You're going to be an American one of these days, Simon, with that kind of attitude.
I don't know, man. Europe's making a comeback. I'm starting to write a piece about that. Like, we're coming. We're finally coming. We're going to get rid of GDPR. There's going to be less red tape. There's going to be like more founders doing stuff.
You're going to have free trade with China and, cheap shoes and T-shirts. It's going to be amazing.
Hey, it's going to be beautiful. Beautiful.
All right, awesome. It's good to talk as always, Simon. See you around.